Hello friends, welcome to our YouTube channel, The Learning CA, a channel dedicated to providing knowledge videos for chartered accountants and finance professionals. Today we will be covering the key aspects of foreign tax credit provisions. So guys, this is part 2 where we will be continuing with the remaining part of foreign tax credit provisions. So guys, this is the thing under credit mechanisms. There are two types of credit mechanisms, as you must have learned under part 1, which is bilateral tax credit and unilateral tax credit. Further, under bilateral tax credit, there are further two mechanisms, which is one which deals with income approach, that is exemption methods, and the other mechanism is tax approach, which are credit methods. So under part 1 we have also gone through full exemption and exemption with progression, also illustration with regards to same. Under this credit methods, there are 4 different credit methods, that is full credit, ordinary credit, tax sparing credit and underlying tax credit. So guys, before proceeding to this, we hope this entire FTC session is being helpful for you, and we also urge that for better and quick listening, you may reset the playback speed to 1.25 to 5x, and if you like this video, please like, share and subscribe our channel, The Learning CA. Now guys, we'll move ahead to the remaining part, that is the third method, which is tax sparing method. So when a contracting state agrees to grant relief from a resident's taxation with respect to the source taxes that have not actually been paid, that is what we call as taxes which have been spared. Now under this method guys, the actual tax payment in the country of source country could be nil, and yet taxpayer would get credit of an amount of tax which would have been paid in the country of source had there been no such exemption under the domestic laws. So guys, under this particular method, a hypothetical tax credit is given to the taxpayer even though the taxpayer has not paid the actual tax in source country. So we may find example of such method under the India Canada TAA. You can go through this particular clause of that article to find that extract. If you just see the last lines of this entire statement, that is the tax payable in the Indian profits, incomes or gains arising in India shall be deducted from any Canadian tax payable in respect of such profits or income on gains. So if you just read this entire extract, which says that even though there has not been paid any tax in India, still a Canadian taxpayer may get the rate of taxes which he would have paid in India on that particular income. We'll see illustration to understand entire this thing. So again guys, assumptions. So we have so this entire illustration has been presented from the perspective of Canadian tax resident, correct? So now there are assumptions to this, that is income earned in resident country we have assumed, that is in Canada, is 6 lakh. Income earned from source country is 4 lakh, and taxes paid in source country, as you may say, it is nil. So there is no tax actually been withheld or paid in the source country. Now if on that particular income there was tax being levied on the source country, we have assumed that if there was a 20% tax rate which would have been levied if that income would have been charged in the source country, and the tax payable we have assumed in the residence country as 30%, so that is 3 lakh, that is of total income. So how we will compute the net tax payable when there is this tax sparing method? That is tax payable on overall income, that is 3 lakhs as stated above, and out of that, if there was a taxation of 4 lakh, if the 4 lakh would have been a taxable income in the source country on which the tax would have been paid, that is 20%, then 80,000 would have been the tax paid in the source country, which has not been actually paid, but still the credit of 80,000 will be admissible in the country of residence, and accordingly the net tax payable in the residence country would be 2,20,000. So this is how tax sparing method works. I hope this is clear. We move forward to the other method. Now guys, this is underlying tax credit method. Now under that, the underlying tax has been defined by OECD as the tax which is charged on corporate income out of which dividends are paid, but which does not appear as a direct deduction or withholding from the dividend itself. So for example, corporate tax on profits before dividend distribution. Now that is what it means, that is underlying tax. Now what is underlying tax credit? Basically, in relation to a dividend, credit for underlying tax is credit for tax levied on the profits of the company out of which the dividends have been paid. Now such relief may be given either under a tax treaty or in an accordance with the unilateral provisions. This is an example of that extract from India Singapore TAA. As you may see that where the income is, so I am just reading that extract, where the income is a dividend paid by a company which is resident of Singapore to a company which is resident of India and which owns directly or indirectly not less than 25% of the share capital of the company paying the dividend, the deduction shall take into account the Singapore tax paid in respect of the profits out of which the dividend is paid. So such deduction in either case shall not, however, exceed that part of tax as computed before the deduction is given, which is attributable to the income which may be taxed in Singapore. So guys, this underlying tax rate method would be applied in such scenarios. I'll just show you the illustration also for the same. So we have assumed that there is an ICO which is based out of resident country and there is an ESCO which is based out of source country. An ICO company is holding 100% equity in the ESCO. Now the profits earned by ESCO is 1 million and the tax paid by ESCO on that profits in the source country at 17% is 1,70,000. Now further there are profits. So now the net is the profits which are available for distribution as dividend to the ICO, which is 8,30,000, which is 10 lakh minus 1,70,000. So we presume that the withholding tax on such dividend distributed is 5%. So which comes around 41,500, that is 5% on 8,30,000. So how will be the tax payable in the case in the resident country? So tax payable on taxable income, we presume there is a 25% tax rate in the resident country. So accordingly, on 10 lakh income, the tax shall be payable at 25%, which will be 2,50,000, and the credit which will be admissible, which will be the underlying tax paid in the source country plus the withholding tax paid on the dividend income, which comes across 2,11,500 rupees. And accordingly, the net tax payable in the residence country would be 38,500. So under this entire thing, the taxpayer has got also a credit apart from the withholding tax on dividend, the tax paid in source country. So this is how the underlying tax credit method works. Now we move ahead to the next topic, which is unilateral credit, that is section 91 of the Income Tax Act. Now as you may see, I have listed certain countries with which India does not have DTAA. So I have just listed certain countries here. There could be more as well, but as far as I have checked for these countries, till date there was no DTAA of India. Till date there is no DTAA of India with these countries pertaining to different regions. Now we move ahead. Now how the section 91 is entirely structured. So if you see, there are two subsections which pertains to providing of relief in case of residents, and there is the third subsection which provides credit in case of non-resident taxpayer as well. So what is subsection 1? Subsection 1 deals with requirements for claiming of relief under this particular section, which is that the assessee must have been resident in India in the relevant previous year, income must have accrued or arised during that previous year outside India, and with respect to that income, the assessee must have paid by deduction or otherwise tax under the law in force in the country in question. Correct. So these are the requirements for claiming relief under section 91. So technically this is applied when India does not have DTAA with the other country in which the tax has been deducted or paid by the taxpayer, resident taxpayer. Subsection 2, I will not go ahead in detail, but it deals with taxation of agriculture income in Pakistan. Subsection 3, again guys, this is applicable when a non-resident taxpayer, particularly a partner of a registered firm, receiving an income from that registered firm, and that income has accrued or arise outside India to that firm in a non-DTAA country. So in that case only the foreign tax rate can be claimed by a non-resident partner. So this is what entirely section 91 has been structured. We'll move ahead with the computation of tax rate in the next slide. Now how the computation mechanism works under section 91. So there are three steps which we have to follow. First we need to determine the amount of income that has been doubly taxed. Correct. The second step is we need to compute the Indian rate of tax, and also we have to compute the rate of tax of the relevant country. Now how do we do that? So first, Indian rate of tax is basically amount of Indian income tax after deduction of any relief due under the provisions of this act, but before deduction of any relief due under this chapter, which is divided by the total income, correct? And what is the rate of tax in foreign jurisdiction is basically the income tax paid in the said foreign jurisdiction in accordance with the corresponding laws in the force, and divided by, we divide by that entire tax paid by the total income earned from that country. Now the third step is the credit would be available, that is the rate of tax at which the credit will be available will be lower of these two, that is lower of Indian tax rate and the lower of rate of tax in the foreign jurisdiction. Apart from this, there are also certain key aspects that we should consider when we are dealing with section 91. I have just listed them, you may read the same as is, and I have also quoted the rulings which as in what to these aspects. Now I will just move on to the next slide, which provides for illustration under section 91. So as you can see, we have assumed here the income earned by the resident taxpayer in his residence country is 10 lakhs, and income earned by the resident taxpayer from the source country with which India does not have DTAA is 4 lakh. Now tax paid by that resident we have presumed as 30%, that is 30% on 4 lakh income, and this is 120 which comes up, and the tax rate which is applicable in India, which we have presumed, is 25% for the resident taxpayer. Now how we will compute the tax payable in India for a resident taxpayer? So the tax in India will be charged on the global income, so which will be 14 lakhs, and on 14 lakhs the tax payable would be 25%, that is 3,50,000. So how much would be credit admissible? As we saw in the earlier slide, that the lower rate of the following rates would be applied to the income which has been earned from the source country, which is lower of 25% or 30%. We divided the incomes particularly earned from that country and we arrived at this rate, correct? So 1 lakh is the tax credit admissible, as on 4 lakhs 25% will be available as tax credit only, and the rest that is 20,000 which has been paid outside India by that particular taxpayer needs to be foregone, and that is where the tax payable in India works out to 2,50,000. I hope this clarifies the unilateral tax credit mechanism. I will just move ahead the other slide. So guys, in this slide I have quoted the sub rules pertaining to rule 128. Rule 128 deals with mechanism for availing of that foreign tax credit. I will just go through that entirely. I will just display here the slides. You may note down the particular points and aspects, and appropriately I will take the same forward. Now guys, here rule 128.8, this particularly deals with supporting documentation which is to be furnished for claiming of foreign tax credit. So as you can see guys, under rule 120, as per rule 128, a form number 67 needs to be filed on or before the due date of return of income to claim the tax credit earned from the source country. So these are the documentation requirements to support that the tax credit is admissible for that on that particular income in India. So guys, this was all. We would request you to join our WhatsApp communities for regular such type of updates. We have two communities, that is International Tax and FEMA, and the second one is India Transfer Pricing Knowledge Hub. And you can join these communities and you can be part of our knowledge growth journey. And I thank you for watching. I thank you all for watching this video. Hope you have learned something from this, and please like, share and subscribe our YouTube channel, The Learning CA, for such future videos. Thank you.